Hey everyone, welcome back to Corporate Decoder, the place where we take those long, boring corporate filings and turn them into something you might actually want to watch. Today we are diving into a company that just got a little nudge from the stock market people, and it's not exactly a pat on the back. Let's see what's going on, Serg. Before we get started, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below for more discussion. Neumora Therapeutics, a company with a focus on brain diseases, just got a notice from Nasdaq, the stock exchange, saying their stock price is too low. Basically, they are at risk of being kicked off the exchange if they don't get their act together. The date of the report is May 14, 2025. Let's break down what this means. The core issue is that Neumora's stock price has fallen below the minimum $1.00 per share required to stay listed on the Nasdaq Global Select Market. Think of it like a club with rules, and Neumora isn't meeting one of them. This isn't just a technicality, it can scare investors and make it harder for the company to raise money. According to listing rule 5455 and Zero Nasdaq requires companies to maintain a minimum bid price of $1.00 per share. Since Neumora's stock price dropped below that, Nasdaq sent them a warning letter. This letter gives Neumora a specific time frame to fix things. Neumora has 180 calendar days, which takes them to November 10, 2025 to get their stock price back above $1.00. To stay in good standing, their stock needs to trade at or above $1 for at least 10 business days in a row during that 180-day period. If they can do that, the problem goes away, at least for now. If Neumora can't get its stock price up by November, they have a backup plan. They can apply to move to a different Nasdaq market called the Nasdaq Capital Market. This market has slightly different rules. To switch over, Neumora needs to meet a different set of requirements, like having enough publicly traded shares. However, the good news is they don't have to meet the $1 minimum right away. They will, however, need to pay a fee to Nasdaq. If Neumora doesn't fix things in time, Nasdaq will send them another notice, this time saying they're going to be kicked off the exchange, also known as delisting. Neumora can appeal this decision, but there's no guarantee they'll win. Being delisted is a big deal. It can make investors nervous, make it harder to trade the stock, and damage the company's reputation. Neumora is considering a few options to boost its stock price. One is a reverse stock split. This is where they reduce the number of shares outstanding, which automatically increases the price of each share. It's like cutting a pizza into fewer slices, so each slice is bigger. Neumora wants the option to do a reverse stock split with a ratio anywhere from 1:5 to 1:30. This means they could combine every 5 shares into one, or every 30 shares into one, or every 30 shares into one. The exact ratio will be decided by the board of directors. They've already approved changes to their company paperwork, but they still need the approval of the company owners, the stockholders. Stockholders are going to vote on this reverse stock split proposal at the company's annual meeting in May. One of the main goals of doing a reverse stock split is to keep the company listed on the Nasdaq. If the stockholders agree, the company will proceed with the plan. Of course, there's no guarantee that the stockholders will approve the split or that it will actually work to raise the stock price. Neumora may not be able to meet the Nasdaq requirements even with the split. This report was officially signed by Michael Milligan, the Chief Financial Officer, on May 16, 2025. This signature makes the information in the report official and binding. Now, let's step back and look at the big picture here. Neumora is in a tough spot. Their stock price is too low, and they need to fix it fast. They're trying to develop new treatments for brain diseases, which is a high-risk, high-reward business. It takes a long time and costs a lot of money to develop a new drug, and there's always a chance that it won't work. One of Neumora's strengths is their focus. They are not trying to do everything, but are instead focusing on a specific area of medicine diseases of the brain. A weakness, though, is their dependence on the stock market. If their stock price stays low, it will be harder for them to raise the money they need to continue their research. And a big risk is that their key drugs in development might not succeed. Drug development is a long shot game, and if their trials fail, their stock price could plummet even further. On the other hand, if they get a breakthrough, they could become a major player in the pharmaceutical industries. In conclusion, Neumora faces a significant challenge with their Nasdaq listing, but they have options to try and turn things around. Whether they can successfully navigate this situation will depend on their ability to execute their plans and ultimately on the success of their drug. Alright, that's our breakdown of Neumora's situation. What's your take on these challenges and opportunities they face? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.